Hey there, curious minds. Welcome back to the Deep Dive, your shortcut to being well-informed. Today, we're diving deep into the wisdom of one of the greatest investors, really of all time, Peter Lynch.
That's right. We're digging into his iconic book, One Up on Wall Street.
Exactly. And you might think investing is, strictly for the suits on Wall Street with their complex algorithms and all that. But what if we told you that you, the everyday observer, actually possess a built-in, pretty powerful advantage they often overlook?
Yeah, that's the core of it. We're here to unpack Lynch's really quite radical idea that the individual investor, the one often dismissed as dumb money, is actually in the best position to spot incredible growth opportunities.
He called these 10 baggers, right?
10 baggers, yep.
Yep.
Stocks that return tenfold or more on your initial investment. And the key is simply paying attention to the world right around you. It's not about advanced math. It's about, well, common sense.
So our mission today is basically to arm you with Peter Lynch's core philosophy and his practical insights. We want to show you how to turn your daily observations into potential investment gold, help you sidestep the common pitfalls even, seasoned pros fall into, and ultimately give you a powerful, enduring edge in the market. Get ready to look at your shopping cart, your workplace, even your own home in a totally new light. Let's explore how.
Okay.
So let's jump straight into Lynch's most, empowering message. The layperson, the individual, can absolutely outperform the professionals.
Yeah, he saw it happen again and again from his perch at Fidelity.
Yeah.
He argued that just by observing business developments, what's new at the mall, what's changing at your workplace, you can find successful companies way before Wall Street analysts catch on.
And this jump on the experts, as he called it, that's what generates those incredible 10-baggers.
What's truly fascinating here is that Lynch himself, this guy ran the multi-billion-dollar Magellan Fund, right? He openly admits to missing obvious opportunities himself.
Really? Like what?
Well, take Amazon.com, for instance. He completely understood the business, thought it was reasonably priced back in 1997, well-financed.
Okay, sounds good so far.
Right. But because it existed in what he called cyberspace, rather than a familiar suburban mall space, he just overlooked it.
Wow.
And that single stock went up tenfold a 10-bagger in 1998 alone. It's a powerful lesson, Be flexible, trust your own judgment, even if it pushes you a bit.
It makes you wonder, if Peter Lynch missed Amazon, how many other things are the big funds missing?
Exactly, because he also points out the built-in disadvantages professionals face.
Yeah, talk about that.
Well, think about it.
Yeah.
Big fund managers are under constant pressure. They're always explaining their choices to clients. Lynch humorously calls Flint at white bread, the super cautious type who might complain about a good stock just because it's down for a bit. This pressure creates an unwritten rule on Wall Street. You'll never lose your job losing your client's money in IBM.
Meaning it's safer to stick with the big known names, even if the upside isn't great.
Precisely. Safer for their career, anyway. Better to play it safe with blue chips than risk it on a smaller, maybe unknown company, even if it could be a huge winner.
Okay, that makes sense.
Yeah. So that pressure, plus SEC regulations that limit how much of a company a mutual fund can own, it pushes them towards those large, already covered companies. And that leaves thousands of smaller, potentially explosive companies off the radar scope for them.
But wide open for us to discover.
Exactly. Wide open for you.
So before we start dreaming of finding those 10-baggers, Lynch insists we do something first, the mirror test.
That's right, the mirror test. And it's less about market knowledge, really, and more about personal preparation. He wants you to ask yourself 3 crucial questions.
Okay.
Basically, he wants you to honestly assess your financial stability and, just as importantly, your personal temperament. Are you actually ready for the long game of investing?
Got it. So question 1.
First, do I own a house? Now, this might seem a bit odd for a stock-picking guide.
Yeah, I was going to say.
But Lynch sees your home as a superior investment to stocks for building that primary layer of wealth. It gives you leverage, potential tax breaks. It's a hedge against inflation.
And crucially, you won't panic sell it based on a bad headline.
Exactly. They don't publish the Friday closing price of your house in the paper. It provides that bedrock of stability, so you can approach the stock market with less desperation, more patience.
Okay, makes sense. Second question.
Second, do I need the money? This is critical. Stocks are for money you genuinely won't need for like 10 to 20 years. Minimum.
So not for next year's tuition or a down payment in 5 years?
Definitely not. Stocks can be super unpredictable short term. Even the big blue chips can fall and stay down for years. But Historically, over the long haul, many decades, they've offered predictable and, frankly, far superior returns compared to other assets.
All right. And the third question, this one sounds personal.
It is. Do
Yeah.
I have the personal qualities that will bring me success in stocks?
Ah, like what?
Patience, number one. Self-reliance, common sense, an open mind, and crucially, the ability to ignore fear and resist panic selling.
That sounds like the hardest part.
It often is. He talks about playing golf in Ireland during the 1987 market crash, right? Fielding calls about his fund losing $2 billion in a single day.
Wow. I can't even imagine.
But even then, he realized that the people who sold in desperation, they always sold cheap. It's a marathon, not a sprint. Emotional resilience is key.
So it's really about temperament as much as analysis.
Absolutely. And that long-term view, he illustrates it with this little Rip Van Winkle fable. Imagine $20,000 invested in corporate bonds at 5% for 60 years. It grows to $373,584. Respectable.
Okay.
But the same $20,000 in stocks averaging, say, 9.8% historically, over $5.4 million.
Whoa, that's a massive difference.
It's huge. And it's not just interest, it's company growth, innovation, compounding returns. Stocks grow exponentially more because you're investing in businesses, in progress.
Okay, so let's say we've passed the mirror test. We're mentally and financially ready. How do we actually find these hidden gems, these 10-baggers?
Right. And this is where Lynch says stock picking is more art than science. Remember, he was a history and philosophy major, not a math whiz.
Yeah, he said all the math you need you get in 4th grade, right?
Pretty much. So, his secret, it really boils down to leveraging your personal experience, becoming an active observer in your daily life.
Like his wife discovering legs.
Exactly. Carolyn Lynch discovered legs pantyhose during test marketing. She just noticed the innovative packaging, those colorful plastic eggs, and, more importantly, saw women leaving the supermarket having bought tons of them. This is before it was a big national brand. A direct, tangible observation.
But you mentioned even Lynch missed things right under his nose.
Oh, yeah. He missed Paychex, a company his own wife used for their family foundation. It had consistent earnings growth for decades, but he just didn't connect the dots.
So it's not just seeing the company, it's actively observing and thinking about its business prospects.
Precisely. Active observation. And he loves businesses that, well, sound dull, or do disagreeable things, or just plain boring.
Huh. Why is that?
He jokes that Wall Street's unwritten rule is, if you don't understand it, put your life savings into it, meaning pros often chase complexity. But you should do the opposite. Think about Safety Clean.
What do they do?
They wash greasy auto parts and recycle the sludge. Not glamorous. Or Envirodyne, making plastic forks and straws. These often go unnoticed by the pros until the value is just undeniable.
So the lack of glamour means they're often ignored and undervalued.
Exactly. Less competition from big funds. And they often provide essential services nobody wants to think about, but everybody needs, like waste management despite toxic waste issues. Even mafia rumors back in the day, it became a 100-fold winner for early buyers who saw its real value.
Okay, look for the unglamorous, the essential, but maybe disagreeable. What else?
He also advises investing in companies that are users of technology rather than the tech makers themselves.
Ah, interesting. Explain that.
Well, instead of investing in a computer company facing brutal price wars, invest in, say, automatic data processing, ADP. They process millions of paychecks. As computers get cheaper and more powerful, ADP's costs go down, boosting their profits.
Or supermarkets using scanners.
Perfect example. If a scanner helps a supermarket cut costs just 3%, that tiny improvement might actually double the company's earnings because margins in that business are so thin.
That's a great point, especially now with AI and stuff. Bet on the companies using the innovation effectively.
Right. You benefit from the innovation without the often cutthroat risk of creating it.
Makes sense. And beyond the type of business, he points to two critical signs of a great company.
Yes. Number one, significant insider buying, especially by lower-level employees.
Not just the CEO buying a few shares.
No, I mean, that's nice, but seeing an employee making, say, $45,000 a year by $10,000 worth of stock, that's a huge vote of confidence. They know the day-to-day reality.
Okay. And the second sign?
A company buying back its own shares.
Why is that so important?
Because it shows management believes their own stock is undervalued. It's the best use of their capital. Better than, say, making a questionable acquisition. Lynch calls that diversification.
Huh? Diversification. I like that.
Yeah, he points to Exxon. They resisted diversifying into unrelated stuff and just bought back their own stock. They consistently outperformed competitors like Mobil, which went on acquisition sprees. So the question for you, the listener, is, What companies around you are showing these signs? Insiders buying, share buybacks.
Good question. Okay, so to help focus, Lynch also puts companies into categories.
Yep, 6 types. Knowing the category helps set realistic expectations. You've got slow growers, mature companies growing like GDP, stalwarts, big ones like Coke, steady growth, some recession protection, cyclicals like Ford, big swings with the economy, so timing is key.
Right.
Then, fast growers, small, aggressive, your 10-bagger potential lies here. Asset plays companies with hidden value like land or patents, think Penn Central with its Florida land. And finally, turnarounds troubled companies like after a disaster, that might recover for huge returns.
That framework is really helpful. For cyclicals like Ford, what's the biggest danger? Just buying at the wrong time.
Timing is everything. The danger is buying when earnings look great, near the peak of the cycle, then the economy slows, the stock tanks.
And people panic and sell at the bottom.
Exactly. Just when the recovery might be starting. Classic trap.
And he also warns about specific things to avoid.
Oh yeah, definitely. First, avoid hot stocks in hot industries. Think dot-coms in the late 90s. Prices totally disconnected from any actual earnings.
The no E and the PE ratio, as he put it.
Precisely. No earnings to justify the price. Second, be really wary of whisper stocks.
Whisper stocks.
Yeah, those exciting, maybe complicated long shots with no real track record, often based on some futuristic tech. Lynch admits he lost money on every single one he ever bought. His advice: wait for proven earnings, even if you miss the initial hype.
So it's better to be right about the business fundamentals, even if you're a bit late to the party.
Absolutely. Long-term performance comes from fundamentals, not just buzz.
Okay, analysis time. He's not big on complex metrics, sticks to fourth grade math. What simple numbers should we focus on?
Forget the fancy models. Focus on practical stuff. Number 1 is the PE ratio, price relative to earnings per share. His rule of thumb. The PE should be at or below the company's earnings growth rate.
Give me an example.
Sure. Company growing earnings 12% a year, PE is 6. Attractive. You're paying half the price for its growth. But if it's growing 6% and the PE is 12, unattractive, you're paying double its growth rate. Simple check for value.
Okay, that makes the PE much clearer. What else?
Look for strong cash positions, especially net cash after debt. Low debt is crucial, particularly for turnarounds. It determines who survives a crisis. Pay attention to inventories. A buildup can signal trouble, especially in fashion or tech.
Right, getting stuck with old inventory.
Exactly. And he warns against relying too heavily on book value.
Book value. That's assets minus liabilities, right?
Yeah.
What you theoretically get if they liquidated.
Right. But it could be wildly misleading. Penn Central, again, book value was $60 a share when it went bankrupt. Its useless tunnels and rail cars counted as assets. The real hidden value, things like natural resources, brand names like Coke, patents, often isn't reflected in book value. That's where the unappreciated value can lie.
Great point. A simple number hiding a lot. Okay, finally, the psychological game. Seems like half the battle is just keeping your head straight.
It truly is. Lynch says the best times to buy are, 1, during year-end tax loss selling, when people dump stocks.
Creates bargains.
Right. And crucially, during market collapses, drops, burps, hiccups, and free falls. After the '87 crash, he mentions Dreyfus traded at $16 with $15 in cash per share.
Wow, so the risk was almost nothing.
Pretty much. Especially since they also benefited from people moving into money markets during the panic. It was an obvious opportunity if you could just ignore the noise.
So when the sky feels like it's falling, that's often the best time to look. But what about the other side? The mistakes we make. Dangerous thoughts.
Oh, he highlights a few common ones. Never say, if it's gone down this much already, it can't go much lower. He cites Polaroid falling from $143 to $8. Or Kaiser Aluminum just kept falling. That's anchoring bias, fixating on a past price.
Right. Fundamentals matter, not where it used to be.
Exactly. The market can stay irrational longer than you can stay solvent, as they say.
Yeah.
Fundamentals are your only real guide.
What about impatience? That gets me sometimes.
Yeah, don't sell just because it's taking too long for anything to happen. He mentions Merck went nowhere for 9 years despite steady earnings growth. Then, boom, shot up fourfold in the next 5.
Patience pays off.
It does. And Lynch's own rule is simple but powerful. Unless I'm confident enough in the company to buy more shares, I ought to be selling immediately.
Meaning, if you wouldn't buy more at the current price, why are you still holding it?
Exactly. He admits he sold Toys R Us too soon because he was watching another investor, not the company itself. He realized he was betting on the other guy, not the fundamentals. Big lesson.
Huge lesson. So ultimately, his advice is invest in companies, not the stock market itself. Ignore the daily ups and downs, the predictions.
Right, he calls market predictions futile. His biggest winners were stocks he held for 3, 4, maybe more years. Understand that stocks can move opposite to fundamentals short term. Focus on the business, not the ticker tape.
So there you have it, a really deep dive into Peter Lynch's powerful and honestly quite timeless insights for the individual investor.
Yeah, from spotting a potential 10-bagger at the mall to just navigating the psychological roller coaster of the market, his advice really does empower you to take control.
The main takeaway seems to be embracing your advantages, right? Your freedom from institutional rules, your unique view of the world.
Absolutely. Your perspective, your ability to be patient. Don't let the noise from Wall Street or economic forecasts scare you off. Do your homework, trust your own observations, and really understand the businesses you invest in.
It's fascinating how much simple common sense plus a bit of discipline can still be a superpower in finance today. It really puts the power back in your hands.
Which leads to a really important question, I think. As you go about your day-to-day, listening to this maybe, what overlooked or maybe disagreeable but essential business are you encountering? Could that be the next great 10-bagger, hiding in plain sight, just waiting for your unique deep dive?
Keep those eyes and minds open. We'll see you on the next deep dive.